Good evening, everyone. Welcome to our Libro Credit Union webinar this evening on family farm succession planning. We're pleased that so many of you have been able to join us. 7 o'clock. It's obviously where I am anyway, a little windy and stormy outside tonight, some rain coming down. So if we do have any connection issues, we apologize in advance, but we're pretty confident things have been working pretty well. Our topic tonight for family farm succession planning, certainly an extremely important topic, one that we talk about with a lot of Libro owners on a regular basis. And we have also recognized that it's not necessarily the easiest topic to start conversations on. There's many reasons for that. Sometimes the conversations can be uncomfortable. Sometimes the conversations can feel overwhelming and you're not sure where to start. And sometimes there are concerns about the family dynamics and other issues that may be involved in the conversation. All that to be said, though, that any plan is better than hope, because hope on its own, just hoping that it will all work out, is not a great plan for the family farm. My name's Paul McQueen. I am the VP Wealth at Libro. I don't really like that title. I don't think it really explains my role very well. I prefer VP of Financial Planning and Investor Behavior because I think that more reflects the work that our coaches, financial advisors, financial planners are doing with our owners each and every day. And so on behalf of all of my colleagues at Libro, over 700 of us today, and our 110,000, close to 110,000 owners, certainly welcome you to tonight's presentation. We believe that this topic of planning, especially when it comes to something as important to Southwestern Ontario as the family farm, really ties in well to our purpose and our B Corp certification. Tonight's speakers, myself, host, facilitator, who's certainly able to participate with the question and answers that we'll try to get involved. We're also joined tonight by Dave Vanoss and Doug Carroll. I'll introduce Dave first. Dave is our Senior Manager of Agricultural Markets, where he provides expertise and leadership to our agricultural relationship managers who work with owners in ag every day. We could actually just go back one slide, please. Thank you. Dave has been with Libro for over 25 years in a number of roles, starting as an account manager in Arkona, supporting farms and small business. He's been a branch manager in Watford and was the regional manager for our Lambton, Kent, Middlesex region. Dave grew up on a hog farm and currently operates a 150-acre cash crop farm in the Forest area. Dave has a lifelong passion for agriculture and its importance to the long-term prosperity of all of our communities. I'm going to turn it over to Dave for a few moments.
All right, thank you, Paul. Making sure that it's moved over to me. Am I ready to go, Karen?
All set.
Okay, thank you very much. All right, thanks, Paul. Hi, everyone, and thank you for attending tonight. As Paul mentioned, my role within Libro is to support Libro's very important agricultural segment. At last count, we're working with over 3,000 farms and farm businesses in Southwestern Ontario. And notably, all that effort with those 3,000 owners, we're sitting with, or Libro holds the largest ag lending portfolio of all Canadian credit unions. So we're pretty proud of that. It's a very vital agricultural area here in Southwestern Ontario, and all of you on this call are part of that. So that's something we should all be proud of. Borrowing is an incredibly important to our owners, but it is not the only area where Libro supports our farm businesses. Items such as simple as day-to-day banking and retirement planning, these are all parts of our services. But for those of you on this call, regardless of all the different services that you are utilizing from Libro, all of your farm businesses will eventually need to transition your business in some manner, which of course is tonight's topic. Throughout my time at Libro, farm succession has been a challenge for many owners. I've had many conversations over the years. I've witnessed some great successes, and unfortunately, I've witnessed some not so great situations. One common thread that I've noticed with the successes, they all involve significant planning that included both strong and timely communication. So that'll tie back a little further as we get going tonight. I'm pleased that Libro continues to build resources where we can host important information sessions such as this to help owners plan their own journey with farm succession. This is possibly going to be one of the most challenging topics your family farm will encounter. We want to help you with that. Success tonight for me from this webinar will be all of you leaving with the confidence to start more deeply considering your own personal farm succession needs. We also want to confirm with all of you that your Libro coaches are ready and willing to support you, and as needed, refer you to the best resources available all along the way of your journey. So for the most part, I'll be in the background tonight. Doug will be calling on me as needed, Doug and Paul, I suppose. And so once again, I thank you for attending, and I will hand it back to Paul.
Thanks, Dave. And we're delighted to have Dave's expertise here with us this evening. Yeah, if we just want to jump ahead one slide there, Karen, before I introduce Doug, a couple things to make this webinar a little more interactive. It is in some ways one way you can see and hear us, but we cannot, absolutely not see or hear you. But if you do want to participate with questions, there is the opportunity to ask them via the chat feature. It should look similar to the type of logo that you see there. It may appear on your screen as a thought bubble with a question mark, but either way, please feel free to ask your questions there. General questions in this forum certainly work best. If there are questions that are overly personal or overly specific, we may need to refer them to a deeper conversation with your coach. Tonight's presentation will be available on our website, and there will be a post-event email with relevant materials from tonight's conversation. So with that, I'm going to introduce Doug Carroll, our guest speaker for the evening. Doug is the tax and estate specialist for Aviso Wealth. Aviso is our wealth management partner and to credit unions across Canada. For those of you who may have investment accounts with us through Credential Asset Management, or Credential Securities, Aviso Wealth is the parent company of that dealer service. Doug previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug holds a business degree and a Master of Law specializing in tax, and is qualified as a certified financial planner and a trust and estate practitioner. He's been doing this for over 25 years, now supporting our financial advisors and financial advisors and credit unions across the country. He's provided written articles, he's provided individual case consultations, and of course, webinars like we're providing this evening. Mr. Carroll, over to you.
Okay, and I can't see it myself right here. I can see you actually, Paul, but I just want to make sure that my screen is up there. The PowerPoint screen is up there for people to see, and then I'll launch into the words that I have to add to that. So as long as that's okay, I'll be off and running with this topic here. And I do want to say that the coordination of our respective expertise and roles is really important. I'm not a farm person. I don't have anything against farms, but I don't want to overstate my skill set. My background is as a lawyer. I ran law practice doing estate planning, state administration type of work with a lot of small business owners, a few in the farming area, but I haven't run that practice for quite a long time. As Paul mentioned, I work as a support person for the advisors who you're familiar with through Paul. And I do want to state that because the things that I'm going to talk about are about the tax and the estate rules and issues that are relevant for transferring ownership of property generally, so estate planning, but then specifically special rules that apply in the farming sector. So that's the area that I'll focus in on. I don't have any great depth of knowledge in terms of the substantive issues involved with running a farming operation, which is what Dave deals with on a regular basis, longer apparently than I've been doing what I do. So here are the topics that we're going to get into here. And I know that Paul's going to stop me from time to time if something comes up, if somebody lays down a question that we want to deal with. But I'll run this through as a thread. We've got 10 topics that I'll take you through. The first, not quite half of them, are more of the foundation of the reason why there are special rules related to the farming sector, and the fundamentals of estate planning more generally, and then carrying it over into the farming sector. And then I'll get into some of those very specific rules. And I'm actually quite sure that you will have heard about all these rules, or some of them in one way or the other. And my role here is to give them some context, explain how they work on their own, and also in combination with the other rules that give you more options, more flexibility on how you look to transfer over your farming operation. So as I'm speaking here, the things that I'm saying are relevant both to you as the current farmer, the senior of the relationship, as well as to the successors who will come in, who will take over. So it's both sides of things, but I'll speak mostly from the point of view of you as the person who is planning the succession of your farm. And as I said, the tax rules are there to support farm succession. And it's not just because we as a Canadian population appreciate those in the agriculture sector. I think there's truth to that, but also just from the practicality of it. Being in the business you are, and again, I'm not going to pretend like I'm in the business, but being in the business you are, it is very capital intensive and it's very land intensive. You've got a lot of machinery, you've got a lot of moving equipment, as well as the land itself. And because of that, you do have to have a long-term view of what you do as a business activity. And you need to be committed to it, because it's not something that you can say, well, I'll try this year and then I'll change up, and the following year I'll do something entirely different. You need to have some consistency. You make adjustments as necessary, but you have to be looking out longer term. And the fact that you have these hard assets, both the land and the physical equipment, that are needed to assist you in doing what it is that you do, means that you are one of those situations, like a lot of small business owners, and don't mistake that word small. Small business means very, very large businesses in quite a lot of cases. But as business owners, you are asset rich in a lot of cases, but you're cash poor. And that is particularly possible to be the situation where you're in a farming operation. So not only do you have, as with any small business owner, the likelihood that your wealth is tied up in the thing that generates your income. So that's the first stage of the goose and the golden egg, that your wealth is in the same place that your income rises out of. But also, you likely live on the farm, or have lived on the farm, and depending on the stage that you're at, that as well will be a substantial amount of your wealth and your connection, both with the operation itself and with the community overall. So you've got a lot of those things going on, that if we don't have tax rules that assist people who are in that situation, then it makes it very difficult to maintain those operations, to move them down into the next generation, or down multiple generations. Because those multiple generations below you, as much as you may have raised them well and they've done decently for themselves, chances are they don't readily have the cash to buy you out immediately. And as Dave was saying, borrowing, the need for the use of credit, is an important part for all businesses to sustain operations, but particularly in the farming sector, it can be a really important part. That's a necessary partnering of the money that's available to assist you when you don't have the readily available cash to get you to where you need to be when you'll have the surplus, then to retire that cash. So in terms of the farming succession, I want to suggest to you that there's at least 3 types of planning that may be going on that you want to keep an eye on. Your retirement as the farmer, the farm itself and its plan, and then the plan for who's going to own that later on. So starting with that first one, looking at your own planning, and this is true for anyone as you're looking out towards your later years. And retirement's kind of a soft definition that applies to retirement. Retirement is in theory the time when you completely stop working. Well, in my experience, a lot of farmers don't completely stop working. There's a transition time of being full-time with it, and then maybe being lesser and trailing off later on. Whatever it might look like, you want to think about what your later years look like. What kind of a lifestyle are you going to have? And when I say lifestyle, I'm not talking about lifestyles of the rich and famous, that you're going to have this caviar, whatever it is. What I mean is, what do you see yourself doing in your retirement years, just in the normal times that you spend day to day, week to week, occasionally going out a little bit larger in some years? Where do you see yourself spending the time? How do you see yourself spending the time? And what does it cost to maintain you in that particular lifestyle? Will the farm operation at the time when you transfer out of it, when the succession happens, will it provide you with the income that will support that entirely? Or do you need funding from other places? So do you need to learn more about investments, retirement planning, tax shelters that are available through the Income Tax Act, the other places where you might invest your money? So how much do you need to take out of the farm operation to support you personally? Then the second part of the planning stool, of this three-legged stool, is for the farm itself. Is it ready to go so that your successor, one or more successors, will be able to run it? Do you have operations manuals or the equivalent of that in terms of knowledge, which is laid out so that he or she who is going to carry on from you will be able to keep turning the same cranks that you are turning? And do they understand how to do that? So the operation itself needs to be prepared, documented in an adequate way. And then the person who is going to take over, I won't keep on going back for one or more, but whoever is going to take over as successor, is there a gap in that person's knowledge or skills that needs to be filled in order for them to do the jobs that are necessary? And how long will it take for them to gain that knowledge? Which gives you a lot of that time frame thought that Dave was making mention of, looking out into the future, making sure that you've given enough runway to have a good succession, one of the positive ones, rather than the difficult ones that possibly can come about. And the last part here is not about who's going to run the operation, but who's going to own it. And quite often it will be one and the same person. In other cases, it may be that other family members may continue to hold some interest in the operation, or maybe you break things apart in a way that each can carry some component of it. And if you're going to have a breakup of who's going to own what is that going to look like? Is the person who is running the operation going to be interfered with, whether you look at it as a terribly bad thing or just somebody looking over their shoulder? How are they going to be able to do the job they want to do and not be distracted by those others whose wealth or eventual wealth is also tied to that same operation? So we quite often, when we talk about estate planning and succession generally, talk about equalizing an estate. But I use the phrase here, the term here, equitizing, because you won't necessarily have equal amounts. Chances are the bulk of your wealth, almost all of it in a lot of cases, is entirely in the farm, and you can't easily dice and slice that out so that some can have parts of it and others can have other parts of it. In that case, you're going to have to be a little bit creative, not the only ones ever in history that has to look at this issue, but be a bit creative on how it is you provide for those family members. And so equitizing means that perhaps you have other things that are going to go to them, including possibly the use of insurance as a stand-in for the assets that you are not able to provide for them directly because you have the farming operation as the bulk of your wealth. Insurance can serve the purpose of assisting with the way that you equitize with those others. Now, in terms of that estate planning foundation, commonly with estate planning, the core documents are to make sure that you have a will, which transfers things that you own at the point of your death, as well as powers of attorney, which are documents where you can name someone else who make decisions about you or your property while you're alive. So those things are fundamental for any kind of estate planning. Where you have a farm operation, because it's larger than and it's more complex than the average person's estate, then possibly you'll have a trust involved. You might have a corporation or more than one corporation. You might be freezing the value of the shares of the corporation in order to try to push off the future growth to the next generation and not having you taxed on it. And yes, I'll come to the tax rules that allow you to, if you fit within the rules, to escape some of that tax anyway. But there may be these other structures that that might be put in place. You might use joint ownership, as people use joint ownership generally, to add someone onto the ownership of property, so that upon the death of those who are the current owners, the transfer of that property goes to those others via the joint ownership and is not going to come into the will, the estate of the future deceased person. And to make sure that things are not necessarily airtight, but that you've got the safety net in place. Again, life insurance, disability insurance are things that can help to make sure that that you've covered those possibilities of things falling through the safety net. The last thing here about family law, this is one of those common questions. Again, I ran a law practice where I was dealing with people doing their estate planning. I'll go see them in their homes quite often. This is quite a while back when I was doing this. And quite often with business owners, I was doing this. Family law, the concern about the possibility that the inheritance that you're passing on to your child ends up with their future ex-spouse is a general concern that people have, and sometimes it's a legitimate concern, sometimes it's just the specter of it. But in this situation, where you're talking about a farm operation, particularly where the home is on the farm property, serious issues can come about that will potentially cause problems with the continuity of the farm itself if you have not really carefully managed the potential claims under family law. And that's not to say that you don't love your son-in-law or your daughter-in-law on a current basis. You have to, though, make sure that you take care of yourself first, and that you take care of the people around you, those children that you have that you're transferring onto, and the thing that you're transferring onto them remains as intact as possible, as much as you can do that. And that's where you have to take a deeper look into family law issues than the average person would do in their estate planning. So I'm going to stop there. I'm going to leave this up because it's got lots of numbers on it for a second, but I'm going to stop there, Paul, just in case anything has come up while I've been speaking to this point, and then I'll get into these. I'm not going to get into all these numbers, but I'm going to get into the numbers with respect to Ontario in a second. So I'll just open it up for you there.
No, appreciate that, Doug. No, we don't have any specific questions yet. I have a suspicion that once we get into the tax conversation, it's possible that a few more questions will come up, because
Okay.
a fairly common refrain is that I'm very rarely hearing farmers tell me that they pay too little in taxes. So suspect there may be some questions to come.
Okay. So when you run any business, there are three legal structures that commonly you can use. You can have a sole proprietorship where you alone run the business, and all of the income, the net income, is taxed to you personally. You could run a partnership, and under a partnership, you have a business run by the partners, two or more, with a view to running a venture for profit. And then the income that is generated from that is allocated off to the partners on an annual basis. And then we also have the possibility of using a corporation. And the distinction between a corporation and the sole proprietorship and the partnership, or one of the key distinctions, is that the corporation is a distinctive taxable entity unto itself, and you can get really nice tax efficiency by using a corporation. I do hear sometimes that that some farmers believe that it's not necessary to use a corporation because you can get the tax benefits of being in the farming sector without having to incorporate. And I think that's a general reference to the availability of the lifetime capital gains exemption on the sale or the transfer of property. And that is true, and I'll come to that. I'll talk to that in just a moment, actually. But in terms of operating the farm, it can be helpful to run through a corporation. So if you look at the Ontario line that's running across here, this is at top tax bracket. I know not everyone is at top tax bracket all the time, but to do the comparison, we're looking at this at top tax bracket, and the concept here also applies even if you're at lower tax bracket. So if you're at top tax bracket, for comparison, Ontario in the middle here, 53.5% tax on $1 of income when you're at top tax bracket, which is somewhere north of $220,000 roughly. So if you have $1 that you've earned from the operation and you want to reinvest into the operation, then you're going to have about 47 cents left if you earn it directly as a sole proprietor or under a partnership arrangement. But if you run through a corporation, then you get the small business rate on your first $500,000 of income, and you get the general corporate rate on the amounts that are over $500,000 of income in a year. So I'm just going to deal with the small business one because the examples work either way. With the small business rate, you get that 12% figure that's showing there, and then if you want to reinvest $1 when you have the small business rate inside of your corporation, you'd have 88 cents to reinvest in activities rather than the 47 cents. I know I'm rounding numbers here. I'm an accountant, or I'm not an accountant, I'm a lawyer, so I'm allowed to round. You'd have 88 cents instead of 47 cents to be invested, which makes it very helpful to keep the operation going, to reinvest, to acquire more machinery, to really be efficient in the operation of the business. Now, eventually you are going to take that money that's inside the corporation and you want to be able to spend it personally, and it's going to be dividended out to you. And that's what that next line over beside the 53.5 and the 12%, the 54%. Once you take the money out of the corporation, then you do have to pay another layer of tax back into your personal hands, and you'll be paying something very similar to what you would have paid if you had earned the income as a sole proprietorship in the first place. But the concept here that we're working with, which is true of all business corporations, is being able to reinvest more effectively by using the lower tax rates, the flat tax rates in the corporation, and then being able to build your business activity as a result of doing that. So there's my outline, my quick outline on corporate taxes and personal taxes connected to one another. And then now I'm going to get into some of these very specific rules that are available for farming. And the big one, of course, is the lifetime capital gains exemption. And it's been around since the 80s. It was brought in. It was actually a general capital gains exemption. And then after a couple of years, it was reserved for farming. And then it was extended out to fisheries as well as small business owners. And the way that it works is that when you sell off any property, capital property, you've got a cost that you purchased it at. If you added things to it, capital costs, and that would increase your cost base. Whatever you sell it for is the sales price. The difference between your cost base and what you sell it for is a capital gain. Half of capital gains are taxable. However, when you're running a small business, generally, okay, so I'll come over to the farming in just a second. When you're running a small business through a corporation, then you will be able to, and you have to fit within the definitions, but you'll be able to sell off the shares of your corporation, and up to 913,000, this is indexed each year, up to 913,000 of capital gains will not be taxable on the disposition of those shares. If you're running a farm operation as well as fisheries, then since 2015, the capital gains exemption has been $1 million. So you can protect $1 million of capital gain on your farming activities, whether you are selling, transferring, disposing of the farming activity directly. So you don't have to be inside of a corporation where it's farming activity, whereas if you're a widget making operation, you'd have to have a small business corporation. If you're running a farming operation, you can either be disposing of the farming assets that you own and make use of the capital gains exemption, or you can also sell shares of a corporation which is operating farming activity. And again, you get the exemption there. Whether you're doing the shares or your direct sale of farming assets, because it's all farming, then you're up to that $1 million level of capital gains exemption. rather than the 913, which only applies to shares. Now, there's some other considerations that go into, and these are not the only considerations. These are the kinds of things when you're having a conversation with your accountant about how you might structure a deal, your accountant and or your lawyer, depending on which one's taking the lead on these discussions. These are the other things that come into play. When you're transferring property, when you're transferring land, you can have land transfer tax. So if you personally directly sell the land, then land transfer tax will apply. However, if that land is inside of the corporation, then there is no change in ownership of the land itself. And so land transfer tax in that case will not apply because you're going to transfer the shares of the corporation. The other possibilities may be that rather than selling the shares, if you own the assets directly, some of those assets, farm machinery, may be subject to HST in Ontario on the transfer of those assets. Again, if you're selling those directly, again, the distinction between selling shares of the corporation that owns those things, or if you own directly, then you selling those things. Or possibly your corporation that sells those things. And again, possibly HST can be applicable there. I'm not telling you anything here that you have to say, oh my gosh, I got to check this box, I got to check that box, I got to check that box. I just let you know some of the complications that can come up on the decisions that you make. When you transfer your property, one of the big issues that can come up is that as you're going into your later years, if you're at a point where you're started with your old age security, which you can start as early as 65, you can delay it to age 70, but you can start as early as age 65. If your income is above a certain level, it's around about 79 to 80,000 right now, then your old age security can be clawed back. Your future in the next year or so, old age security can be clawed back if your current year's income breaks through that income threshold. So on the sale of your property onto the next generation, or the transfer of that property, if there is a disposition, a deemed disposition that applies on that, and a capital gain that applies to that, then you may potentially lose some of your old age security. Again, to be able to plan whether you're going to be exposed to that or if you can plan around it, you do want to start your conversations about your intended planning at an early enough stage that your accountant, your financial advisor can give you some ideas about how you can do this so that you can preserve that if that's something which is really important for you to do. The last item here, alternative minimum tax, I'm going to deal with this directly onto its own. So that's something that is a surprise to a lot of people, alternative minimum tax. It actually exists as a parallel tax calculation for all of us. It's just that it seldom ever applies. Usually what happens is we calculate our taxes in the usual way, and as individuals, we are subject to progressive tax rates. We pay higher rates of tax on higher levels of income. And we do have some tax credits and deductions available to each of us, depending on our particular characteristics. And what the alternative minimum tax is intended to do is that if someone has intentionally or just by their circumstances taken advantage of, and again, I don't mean that in a bad way, but had the benefit of some tax credits or deductions significantly in a year, then the tax rules apply alternative minimum tax, potentially, that makes sure that that person pays at least a minimum amount of tax. And where that comes about quite often is in the year that you transfer the farm. If you do it all in 1 year, then potentially you have a very large capital gain that applies at that time. And one of the add back items in determining alternative minimum tax is the non-taxed half of capital gains. Remember, I said that capital gains, only half of capital gains is taxable under the regular tax calculation, but under alternative minimum tax, it includes, the calculation includes the non-taxed half of capital gains. And even if you use the capital gains exemption against that capital gain, it still will increase the amount of your income for the purposes of calculating the alternative minimum tax. So these benefits that you might have had the advantage of are added back in, Then there is a $40,000 general deduction, and that, if there's a net figure after that, is multiplied by 15%. That is the alternative minimum tax. Quite often with business owners, particularly farm owners, in the year of transfer, because you have that large capital gain, quite often you will have relatively low tax generally if you're under the regular tax treatment, but a significant amount of alternative minimum tax. It could be that your regular tax calculation is more than your alternative minimum tax, and so you don't face the alternative minimum tax, but it does happen that you are subject to this alternative minimum tax. Now, it is not an extra tax that you are paid. In concept, what's supposed to happen is, again, the government or the tax system is making sure that you're paying that minimum, and then you get that amount back over the course of the next 7 years. So as you have tax due based on your income in those following years, then the alternative minimum tax amount is a credit against those taxes in those later years. So you are able to recover that. But if you are someone who perhaps says, I'm done with this, I'm going to have negligible income after this point, it may be difficult for you to recover that alternative minimum tax. And this is one of those accountant conversations, not the first time that I've said it, not the last year. This is one of those accountant conversations about what is the appropriate way to structure your particular succession, so that first you don't want to be exposed to it, or second, if you are exposed to it, that you are able to recover it. Because if you don't recover the alternative minimum tax by the end of that 7th year, then it's gone. So having that advice from an accountant about how you structure things is important to make sure that you don't face those serious concerns potentially of losing out through the alternative minimum tax. I'm going to stop there for a second again, Paul, just to see if there's anything that's come up, and then I'll continue on. But I want to give you the chance to hold me up here.
Yeah, there's a couple questions. There's one specifically about adding children around joint owners of land, but I think we're gonna get into that a little bit later in one of your topics. And then the question about how early do I need to get started on farm succession? That one I felt we could sort of answer. We might be able to answer now.
Yeah, well, and yeah, and there's no right wrong with this. My general to general business owners, my suggestion is that at any given year end, because you're a business owner, so you're going to be meeting with your accountant and or your lawyer, but usually your accountant, to make sure that that you've got all your ducks in a row to file your taxes that year. At every year end, I would say look out 5 years in time and think, do I expect that 5 years from now I will be in the midst of, even if it's the front edge, will I be in the midst of succession? Is that likely to happen? And I say that about general business owners, because 5 years for general business owners, because sometimes you need to reshuffle how it is that you own things. You need to make sure that, again, if there are skill gaps of who is going to be your successor, that you get those skills going. So 5 years is probably reasonable for a general business to be in time for that. Where you're talking about a farm operation, because of the even more long-term aspect of it, because of the larger capital commitment for farm operation versus most other business activities, I would say that you'd extend it out beyond that. I don't know what number is. Maybe Dave's got a better number to suggest, but I'd say that it shouldn't be any less than the 5 years. Maybe it goes as far as a decade in time. I'll throw that back to you, Dave, Paul, what you think about the appropriate time to be looking out.
Yeah, I'd be happy to chime in on that. It was interesting as you were. My first thought when I saw the question is probably 10 years. There's a lot of moving parts with our farm operations. Our farm operations that deal with Libro in Ontario, many of them are sole proprietors. Many of them are set up jointly owned between husband and wife. Many of them have assets held, major assets, farm assets held personally, and major assets held corporately. Sometimes there's multiple corporations. There is a lot of moving parts, and my experience is that it's generally more complicated than what we would describe as a small business in that we deal with Libro. So definitely far longer than 5 years, and I would think if you're heading through 40 and 45 and you haven't started yet, you probably are. It's starting to become more evident that you need to start looking at it.
Okay, so and then naturally, I'm not gonna necessarily come back to it directly and say this is why, but there's a couple of points that I'll make further on that should make it obvious that if you don't take steps at a real early stage, you are limiting the possibilities of what you can do in part, but also the access that you have to those tax rules if you don't start at a fairly early stage of things. So let me move off of the alternative minimum tax, and I'm just going to go through the other tax features that are supportive of the transfer of farms. We all, every one of us, have the entitlement of making use of the principal residence exemption. So on a principal residence, we don't pay tax on the capital gain. When we're spouses, then spouses share that principal residence exemption. It is a per person thing generally, but once you become spouses, you do have to share that. The difference when you're talking about farming is that there is a second rule. So the average person on selling a principal residence, which is not farming related, will be entitled to the capital gain not being taxed on the property itself, the building and the land surrounding it, up to a half hectare. For a farming operation, you do get the principal residence exemption in addition to the lifetime capital gains exemption that I was talking about earlier, which applies for farming, fishing, and small business shares. So when your home is on the farm, you get both of those things. And so significantly, you may have a lot of your wealth, which you are concerned will be subject to a large amount of tax because it's grown up in value, that will be protected by the principal residence exemption in the first place, and then the lifetime capital gains exemption. And there is a second way that the principal residence exemption can apply for farming activities or farming property. Not only can you claim the property itself, the house, the farm building as the farm home, not farm farming operation buildings, but the farm home as your principal residence, but you also potentially can use another calculation, which I've shown in real short form here, allocating $1,000 plus $1,000 per year that you've owned the property after 1971, which is when we had the significant change to the Income Tax Act. It's up to the accountants to advise you on what's the better way to go about it. These days, $1,000 per year is not a really significant amount. You're probably likely to use the general principal residence exemption. It's kind of nice if the government decided they're going to index these things a little bit, because it really doesn't provide much benefit, but there is that possibility if you're a farmer. If your home is owned, though, on the farm, it's owned through your corporation. A corporation cannot claim the principal residence exemption. And that might be something that you did that because efficiency-wise, you were running through a corporation for the farming activities. The cash was being generated there. Had you dividended that out of your personal hands, you would have paid tax on the dividend. So instead, you decided that you're going to buy at the corporate level. That might have been a great idea, may still be, from a cash flow perspective and owning that property, getting into that property, but you won't be able to claim the principal residence exemption on that. The corporation can't do that. We as natural persons can do that. The corporation cannot. Partnerships, there may be the possibility of claiming the principal residence exemption on a partnership interest, but not with the corporation. And the last point here is just to let you know that the principal residence exemption is something that was not all that detailed how we had to report on it in the past, but as of 2016, the reporting rules are much more stringent. You have to report when you bought the property, how much you bought it for, if you made any capital improvements, when you did that, how do you prove that if you're asked to do that, and then what you sell for. And still, you get your principal residence exemption, but you have to provide those details before you can claim it. So I no doubt you're running a business as it is, you're going to have records anyway. It's going to be very important to make sure that you can distinguish between the principal residence on the farm versus the farming itself, to make sure that you have those good records to prove that when you sell the farm property and claim the principal residence exemption. Now, for these rules, the capital gains exemption, and for a couple more that I'm going to talk about in a second about transferring down generations, the property needs to be qualifying farm property in order to get these tax benefits. And the type of property which is qualifying farm property is land, buildings, quota, intangibles. There's a couple other things, but those are the main things that qualify as qualifying farm property. What does not qualify, use that word qualify a little too many times, but what doesn't fall within the definition is equipment, machinery, and inventory. And that can be a surprise if you haven't yet looked into this. However, if you own a corporation, which in turn owns those things, equipment, machinery, inventory, or a partnership which owns those things, then your shares of the corporation or your interest in the partnership may still, because it's involved in farming activity, may still qualify for the rules that allow for both the capital gains exemption and the rollover rules down generations. So again, the use of a corporation may not be something that you're concerned about for the purpose of the capital gains exemption, but depending on how you're running the business activity, it may get you to the point of being able to access more of those rules because you use a corporation rather than having direct ownership or partnership interest. And there is a critical time, a critical date when the rules changed back in 1987. I'll just refer to it as 87. You see it on the screen there, the exact date. If you own the property, as well as the people through whom you owned it, parents that transferred it to you, if the property was owned prior to this date in 1987, then the qualification as qualifying farm property is a less stringent test than if you started owning subsequent to that date. So if you own prior to that date, then on the date that you sell, that you transfer, or you are deemed to, then the property has to be used in farming operations, or any 5 years prior to that time, any 5 years, it could be used in farming. But if you acquire the property after this date in 87, then the rules are a little bit more stringent, and it includes that your income from the property has to be farming property as your primary, your major source of income above any other income for at least a 2-year period. So there's an additional revenue test associated with that. So this keeps people from having hobby farms and then trying to access these rules, which are really intended to assist people who are in the farming business, not people who have their money elsewhere and decide they're going to acquire something and try and get at these rules. So it's important that that you take a look at the dates when the acquisition happened. And then having done that, or having laid that out about what's qualifying farm property, here's where that leads you. With spouses first, you can transfer property between spouses from one to the other at cost base. There's no tax on that. There's no, it is a disposition, but it's not a taxable disposition when you're rolling property from one spouse to another. It goes at its cost base. So this is one of the things you might do if you want to multiply out, that's easy to say, multiply out the capital gains exemption, which is a per person entitlement. So you get the $1 million that's available to you per person who is an owner of a farm operation. So if you're spouses, then having it in one person's name, you can protect $1 million of the capital gain. If you have it in both spouses' names, you can protect $2 million of capital gain. Here's the problem though. If you roll at cost base from spouse one, and I'll just say that's the higher income spouse, the first owner, the higher income spouse to the lower income spouse, if you roll at cost base, then the future capital gains of the lower income spouse are attributed back to the higher income spouse. And that includes the capital gains exemption. So if the capital gains go back to the higher income spouse, there is no exemption against which to apply the capital gains. So coming back to what we were talking about starting earlier, what Dave was saying about 10 years in advance of time, what you want to be able to do is make sure that both of you, and we'll talk about the kids as well, both of you have an ownership interest in the property sufficient that you can, A, have more than one person tax on the capital gains, which is going to reduce the tax bill, but also open up the capital gains exemption. And so rather than having the rollover, you will have the lower income spouse acquire at an earlier stage so that you can get a long period of time of growth that can be in the lower income spouse's hand as well as the original person who is the owner. Now, rolling down generations also opens up the possibilities, multiplies out the capital gains exemption to others, and you can roll the property down from you to your family members, and it has to be used in farming or fishing. And there's a long extended definition that applies to children, grandchildren, great-grandchildren, natural or adopted, children of your spouse, if that's not not your mutual children. It could be your spouse or spouses of those children as well. So things branch out quite a bit as to who you can roll to. So you can roll property which qualifies as qualifying farm property at cost base to those other family members. Now, you won't necessarily do that fully, say, well, I'm going to roll everything. A little bit more sophisticated approach will be to roll some as well as use your own capital gains exemption in the course of arranging these things so that you can bump up the cost base in their hands so that their future capital gain, because then they have a higher cost base, they will have a lower capital gain in future because they're not going from here up to here. They're already at a higher cost base because you're able to then roll to them, but roll at a higher cost base. So I know that sounds really confusing, but that's where the accountants come in to help you get at this at an early stage. Now,
Doug,
oh, sorry, yeah, go ahead.
I just want to jump in there because there are a couple questions when it comes to children. The first one was, are there any risks involved in adding parties? In this case, the example in this case was a child or children as joint owners of the land, as opposed to inheritance or purchase, presumably.
Yes, yeah, and the more layered, more detailed ways to do the transfer will cost you more. It'll cost you more to set up a corporation. It'll cost you more to have a trust rather than simply adding someone on as a joint owner on the property. But the cost of doing those other ways gives you greater layers of protection. If you add someone on and there's no other record to it, you add your son or your daughter onto the property with you, then their rights and their interest in that property now are in their hands, completely in their hands, as well as you. And if they have creditor problems, if they have a wonky marriage, if they just turn out to be not the son or daughter you thought they were, then they've got that claim directly against that property. So setting it up, and I'm not saying anything bad about your kids here, but setting it up with a little bit more strings attached can give you the ability to take advantage of the tax rules, but try to create a degree of separation of the exposure that might be involved with that. And usually the way you're going to do that is to set up a trust. And I'm not going to go into great detail about a trust, but basically what's involved with a trust is you're breaking out the legal ownership from beneficial ownership. So you put them on title via the trust for the property that we're talking about, but you continue to be the trustee over the trust arrangement. So you make all the decisions, and then eventually they will get the property, but you can keep on top of it in the meantime and not have as much exposure if you're going to make use of a trust. I'll stop there so you can jump in, Paul.
No, that's great. And there's a good follow-up question to that. And is there any particular tax or succession considerations if the child or children inheriting the farm and or land are not necessarily going to be the operators? Maybe they just plan to rent it out, for example.
Yeah, I think that there's, yeah, I don't have a simple answer to that. I think that there are things that then grow off of this in a variety of ways. Once you come to the determination or you come to the realization that outright transfer is going to be a little bit too bare to the world, and you start looking into the other possibilities of doing this, then again, lawyer and your accountant are going to have a checklist of things that are concerns and things that create opportunities for you when you get into a little bit more sophisticated approach to how you're doing this. And I know that there's costs involved in engaging these professionals, but they got the skills. They're the ones who can say, here are the possibilities. And this is your property, which is not only that's built up over your lifetime, but quite often over multiple lifetimes of value. So getting that proper advice, both legal and accounting advice, tax advice, is critically important to make sure that it happens as intact as possible from a legal standpoint and as efficiently as possible from a tax standpoint.
Yeah, no, it's a great point, and I think it really goes to our earlier conversation about it's going to cost you something if you don't engage these professionals. If you don't have a proper plan, there's always going to be a cost. That might be financial, that might be family unity, whatever those costs might be. It's always better to address these things in advance. I do have another question for you after your next slide, but I'll let you charge through with this one.
Okay, so I'm going to move on to the next slide. So what we're talking about here, just to recap where we are at here, this is the roll down of property at cost base to your children, to your spouse on the right hand side, but then also to your children on whichever side we are. But anyway, your children as the other one. So it's the roll down to them at cost base. You also have the possibility of selling to them. And coming back to what I was saying off the top about what's the plan? What's your plan for your retirement? What's your plan for the farm operation? What's your plan for the successors of this? Well, let's start with your plan. If you just roll everything, it just give everything to everyone, then what are you living off of? Like, where? I'm sure that you have money in other places, but you're not harvesting out. Sorry to use that word, but it comes in my mouth a lot. Anyway, you're not harvesting out the money that's involved in this. And not say that you get to extract all of it just for you. You do want to have that go into your family's hands, but you still need something to live on. So in doing the transfer, in the broad sense of what the transfer is, you can do a roll down at cost base, but you can also have your kids buy off of you. Chances are they're not going to have all the money available to be able to do that. And that's where the capital gains reserve can come into play. So generally when you sell capital property, if you don't get all the money on the date of closing in 1 year, then you can extend out as long as 5 years. So the year of closing plus 4 years, and you can spread the capital gain over that time period, 5 years worth of time. With farming property as well as fishing property, if you are selling to a child, again with that long extended definition, if you're selling to a child, then the child can acquire from you and pay you over the course of as much as 10 years and spread out that tax liability for you on the capital gain, as well as giving them a little bit more ease to be able to pay you over that time. Now, still, they may not have enough money. So one of the things that you can do then is you can have the sale done a combination of cash so that you can get some out of the operation, but you can also use promissory notes. So you take back some debt from your own kids. And then when you do that, you're facilitating them stepping into the shoes that you want them to. And then later on, at the point of your death is generally how this is done, you then would forgive that debt. So what you're doing then is you're allowing them to buy in at the fair market value that it is right now, which bumps their cost base up where you want it to be. You're going to use up your capital gains exemption either at that time or maybe prior to that. And then they have that as their high capital gain or their high cost base, which is a good thing because that limits their capital gain. And then when you head off into the big beyond, you then forgive that debt and they are able to continue on in the operation and have the benefit of a high cost base and ownership of the property, and everybody's happy. Well, you're gone, sorry, but otherwise everyone's happy.
Okay.
So that's it that I've got here, Paul. I'm gonna bring back the summary here and see if there's any other questions that came up.
Well, there are, and just, I mean, we are getting close to our scheduled end of the time. I know that Doug is always good enough to stay for a few minutes when we've had some good conversation going, but appreciate, we will look to wrap up soon. And there's a couple questions that we're looking to publish and we'll get through, but Any extended family beyond the ones you listed, nieces, nephews, cousins, what have you, that will be included in that definition, or is it pretty strict on who's included as immediate family?
Yeah, so it goes down this definition. It's right there in the income tax. It says income tax act. It says who can be the people you can roll down to. It does include, though, an unusual kind of definition where if you've had someone who, while under the age of 19, was under your care and control, so it doesn't even require blood relation, if you have someone of that nature, then that is also someone who you can roll down to. And that can happen, and it may be something that you might do at an earlier stage in time. That can happen, let's say that you have a niece or nephew who lives with you on the farm, who is literally under your care and control. That person may very well qualify then for that roll down. So there's lots of possibilities. Again, earlier in the planning that you are, the more you'll open up to being able to create those opportunities.
Perfect. Yeah, there was a comment about adding a child as a joint owner could be subject to land transfer tax, et cetera. Discuss the implications with your tax professional. Yeah, absolutely. I mean, anytime you're making decisions with respect to ownership of your property, your corporation, what have you, let's not do that in a vacuum. Let's bring in the professionals to help. Can you use a beneficiary trust in a corporation to sell shares and also in land outside the corporation?
Well, let's just say this. I don't understand the exact linking of all the topics there, but you can use trusts and corporations in combination with one another to achieve probably what the person. Well, I don't know exactly what they're trying to achieve, but you can use both trusts and corporations together to try to come up with a resolution that fits your circumstances quite often.
And maybe, Karen, if you wouldn't mind, if you could bring up the screen that restated the definition of what was qualifying farm property. I think it was a few slides back.
Actually, I've got control over it here.
Oh, sorry, Doug. Yes, you do.
Okay,
the question was, can you restate the definition? So it's, as you touched on there, land, buildings, quota, intangibles. However, if it's everything's owned by shares of the corporation, go ahead.
Yeah. But the definition is, this is for the sake of putting something up on the screen here and not killing you with tiny text. This is the definition. So this is not the entire definition, but it gives you a sense of the big things that are in, the big things that are out, and then the concern that happens if you have, or the concern or the benefit of having corporate ownership, where you have those things that otherwise would be out, they might be back in again.
Okay. Two questions, and that will be it. If we have any others come in, we'll have to defer those to your local coach. If the farm is owned corporately, does there need to be an agreement in place that the parent's shares are purchased by the corporation and the non-active sibling or siblings paid out of the estate, so there isn't a fight for the parent's share?
I'd say the answer to that is there doesn't have to be, but there should be. Anytime it's going to help, yeah. Because that is actually, I mean, I hate to be flip about that. I think that's a good point to be made, though. You have your intention of what's going to happen, and yes, you love your kids, they love each other. Some days, other days a little bit more battling, but don't assume that the way that you intend for it to happen will indeed happen exactly that way. Having a shareholders agreement among the family members from a business perspective is going to make sure that everybody's expectations are clearly stated. And so having that agreement in place helps out with relationships. It might be challenging to get it done in the first place, but it's going to make things clearer over the long term.
Okay, final question for you, Doug. Look into your crystal ball here a little bit, or maybe you've got some insider knowledge to share. Any federal or provincial tax rules being considered that a farm owner should be aware of? Perhaps there's a timeliness question here.
Right. I don't have a crystal ball about any potential things out there. I just don't know. But one of the things, I'm glad you asked that, because one of the things that has happened last year, there's a bill. It's C as in Commons 208, which was passed into law. It was a private member's bill that was passed into law last year, mid-year, and what it dealt with, it was a very brief law that was passed into law. What it dealt with is, if you as a business owner generally transfer your shares to your child's corporation, there's some negative tax results from that, which has always been a concern of the business community overall and farming community who run through corporations. That rule, or that change the rule, relieves the problem that had existed in the past, so that you should be able to transfer from your corporation to your child's corporation now. The Department of Finance said that they're going to look that over and come up with ways that they're going to implement that. I haven't seen that yet. But if you want to look that up, it's Bill C-208. Make sure that's part of the conversation you have with your accountant.
Okay, fantastic. Doug, certainly appreciate the expertise here, the tax focus and other things. Mr. Vanoss, Dave, see if you have any comments for our guests here this evening.
Yes, I want to thank Doug and Paul and all the other folks who are working behind the scenes that pulled us together. It's such an important topic. It's farm succession and farm business planning has always been important, but it feels like the stakes have gotten significantly higher in the last 10 years due to the asset valuations of specifically land would be the main one, not the only one, but the main one. So this is very important and very timely. It's a conversation that we will endeavor to continue to have with the owners of Libro. A couple of things I kind of jotted down here while this is going on. I don't think I made this up. Perhaps Yogi Berra did, but I was thinking about the when to start question again, and I jotted down, it's never too late until it is. And that's what Yogi would do. He'd leave you hanging. So I think that's really so starting earlier allows you not to get into that you're too late. So having those conversations earlier are so important. I also jotted down very simply, any planning is better than no planning. Any planning is good planning. So as you think about, should I put effort into this? If you wonder if you should, I would suggest that you should. I think the last piece I had, and I'd actually jotted this down, no lie, but I will be re-emphasizing the importance of having a farm or an accountant who has a strong agricultural background. The assets that all of us, my wife and I farm also, all of the folks on this call, there's too much at stake to not have the best support you can. So if you're not sure if you have a strong farm accountant, it's likely because there's probably a good clue there, and we'd be happy to speak with your coach and maybe get some ideas of who are some of the stronger farm accountants in your area. That would go for lawyers also. I think if I had to choose between the two, I'd go for the better accountant before the better lawyer. The lawyers generally, they're both important, but the lawyers will take the accountant's instructions. Yeah, those are my final thoughts. And I want to thank everybody for attending tonight.
Yeah, appreciate that, Dave. Thank you very much. I had thought of the proverb of the best time to plant a tree was 20 years ago, and the next best time is today, for sure. But as I said right at the top, that hoping it will all work out is not a plan. But we also recognize quite deeply that these aren't the easiest conversations to start sometimes. And we'd like you to know here at Libro, our coaches care, and we have a team of specialized experts that will be willing to engage with you, and they're not going to be passing along judgment. They want to know what's important to you. Now, judgment doesn't mean they might not want to suggest some alternatives to the current behavior, but we're certainly not here to judge what it is you're looking to accomplish with something that you've put your heart and soul into. That starts with our relationship managers. You deal with them a lot in terms of the lending and the accounts and the deposits and other things. But I like to think of them maybe more as maybe they're not the greatest analogy, but think of them more as the general contractor. They have an understanding of the big plan, and they're going to coordinate bringing in the various trades, the various experts that they need to help build that plan. We have financial planners qualified to work with you. We have insurance representatives ready to help, and we have Phil Boglewski, our wealth planner. He's a non-licensed in a non-sales role, just dedicated to helping some of our highest net worth owners, including our farmers, get started on their planning needs. If you don't know where to start, pick up the phone, send an email, send a text to your local relationship manager, and we'll get that conversation started. Genuinely appreciate your participation tonight. If there's anything we can do to help, let us know. Otherwise, enjoy the rest of your evening. Thank you.